For years, there was a trade that felt like free money. A company gets the call that it is joining the S&P 500 and the stock jumps because every index fund on Earth is now forced to buy it. The demand is mechanical, guaranteed, and known in advance. So the folklore said, get in before a stock is added and pocket the pop. And in its heyday, that pop was real. In the 1990s, a fresh edition jumped on average about 7%. But here is the question worth a few minutes, because the data has quietly changed its mind. Does joining the S&P 500 still pay the way it used to? Let's take it apart honestly. This is market history, not a trade to place. Start with a detail most people who chase the trade never learn. The very first study to document the effect, back in 1986, found that an added stock jumped roughly 3% when the change was announced. That is the number that launched the legend. But the same study found something the legend forgot. That gain nearly fully reversed within about 2 weeks. It was not the market re-rating the company higher forever. It was temporary price pressure, a wave of forced buying that pushed the price up and then faded as the buying finished. So even at the very beginning, the pop was a short-lived bump, not a permanent gift. Hold that thought, because it is the seed of the whole story. Now watch what happened over the decades, because the trend is stark. A peer-reviewed study in the Journal of Finance, called the disappearing index effect, traced the average pop from being added to the S&P 500 across 40 years. In the early 1980s, it ran around 3%. It peaked in the 1990s at about 7.4%, the golden age of the trade. Then it eased through the 2000s to roughly 5%. And in the 2010s, it collapsed to under 1%. So small, it was statistically indistinguishable from zero. The mirror image faded too. The drop a stock took from being removed from the index, once large, shrank to about 0.1%. The free money trade did not get smaller. So what killed it? Not a rule change, arbitrage. Here is the mechanism. Additions to the S&P 500 are chosen by a committee, and they are announced a few business days before they actually take effect. That gap is the whole problem. The moment an addition is public, traders know that index funds will be forced to buy at the effective date. So the traders buy first, ahead of that mechanical demand, and sell it back to the funds into the pop. They compete the edge away before the index funds ever show up. And here is the part that breaks intuition. The effect shrank even as the amount of money tracking the index kept growing. A simple supply and demand story says more index money should mean a bigger pop. Instead, it vanished, because a predictable pre-announced trade is exactly the kind of edge a competitive market arbitrages to nothing. One more sign of the times. The bar to even qualify keeps rising. A company now generally needs an unadjusted market value of about $22.7 billion just to be considered. Roughly 4 times the bar a decade ago. So what is the honest verdict? It depends entirely on which era you are picturing. If you mean the 1990s, the index inclusion pop was real, sizable, and well documented, about 7% on average. If you mean the last measured decade, that same pop is near zero, arbitraged away by traders who front-run a trade everyone can see coming. Both are true. They are just 30 years apart. And that is the real lesson here. Not a stock to buy, but a clean example of how a market swallows an edge once it becomes obvious and predictable. A couple of honest caveats. These are averages, so an individual stock can still move on its own news. And the research runs through about 2020. This is descriptive market history and a lesson in efficiency, not investment advice, and not a strategy to trade index additions. Do your own work before acting on anything.